Welcome to all. I am Dr.A.Muthumani, Assistant Professor of Commerce, Sri S. Ramasamy Naidu Memorial College, Satur, Virudhunagar District. In this video, we are going to discuss about the meaning of capital structure, definition of capital structure, importance of capital structure, stages for capital structure, patterns of capital structure, and last one, classification of capital structure. Now we are going to discuss about one by one. First slide is meaning. Capital structure means it is a permanent financing of the company. That is, a business enterprise has to maintain a proper mix of both these types of securities in a manner that these types of securities means the long-term financing securities like ordinary shares, preference shares, debentures, bonds, long-term debts and the like. It relates to the kinds of securities for raising long-term funds. It implies the determination of form or makeup of company's capitalization. It is also a part of financial structure of a company. Yes, financial structure of a company means it includes both short-term and long-term finance. But capital structure, it primarily concerned only the long-term debt and the shareholders fund. So capital structure is called as a part of financial structure of a company. The mixing of different types of securities is portrayed by the firm's capital structure. The main aim of mixing or proportion of mixing of debt and shareholders fund is such a manner that both the cost and risk are minimum. These two factors are minimum, then only it will increase the market value of share. Then next slide, definition of capital structure. Different authors defined the term capital structure differently, but in this slide we have to discuss about the two authors. First one, author Justin Burke. According to his view, capital structure refers to the kind of securities that make up the capitalization. That is, what are the securities we have to mix up for making the capital employed or for raising the capital of a company. Then second author, according to R.H. Wessel, he defined the term capital structure is frequently used to indicate the long-term sources of funds employed in a business enterprise. Then the next heading is importance of capital structure. The capital structure or the proper mix of capital structure play an important role in the wealth maximization of the shareholders and also increase the value of the firm. The importance of capital structure is, first one, a well-balanced capital structure maintain or a balanced capital structure, it will maximize the market value of share, because a balanced capital structure, it includes a company raise their required finance from various sources at the lowest possible cost. It will increase the market value of share and the market value of shares held by the equity shareholders. Then second important is, a balanced capital structure of a company enables the company to minimize the various risk. That is, the company, by making suitable adjustment between the fixed and liquid assets and also making suitable adjustment between cost and risk factor. Then third one, A well-defined capital structure ensures the retention control over the affairs of the company. That is, if the mixing of debt and equity share capital, if the equity share capital ratio is high, then only the full control or the retention of control is vested in the hands of equity shareholders. If the debt capital is increased, the control over the affairs of the company is vested in the hands of debentures. But here, if the company wants to retain the control over the affairs of the company in the vest of equity shareholders, the equity share capital proportion is compared with more than the debt capital. Then fourth important is, to balance the capital structure helps a company to eliminate the demerits of over and under capitalization. Yes, a planned and balanced capital structure, it will eliminate the limitations of over and under capitalization. If suppose the company having a over capitalization, if so the company having lot of funds as in the form of ideal, but the company should pay interest to that capital also, then it will leads to reduce the benefits enjoyed by the equity shareholders of the company. Then if the company is undercapitalized, it will leads to automatically to interrupt the free flow of regular business activities. That is, there is a delay in supply of material, delay in supply of labors, and every items and everything is a delay. So automatically it will affect the interruption of production. Then next slide is stages of capital structure. The capital structure stages is classified usually under three headings: pioneering stage, second one expansion stage, and third one stabilization or stagnation stage. The first stage, pioneering stage, this is the stage when the company is to start the business operation. In this stage, the company having the company expect a rapid increase in demand for the production or products and services. Automatically the company is to raise more funds with a high rate of interest for the purpose of satisfying the rapid increase in demand. So automatically, if the company raise more fund with the high rate of interest, it will also include very high risk. In this stage, only the efficient companies only survive at this stage, because such companies, that is the efficient companies, are having a good amount of equity and soft loan in their capital structure. Then second stage is expansion stage. Here the company has survived after meeting the competition successfully. Yes, if the company to met the competition successfully, automatically the company moves to the next stage, that is the expansion stage. Here the company wants to expand their market level and production volume, and at the same time to increase the market price. So automatically, if the company expand their production line or production volume, market share, the company needs a high amount of funds. Therefore, the company starts to mobilize the required funds at a high rate of interest. So here there is a chance for increasing debt capital. In this stage also, the company moved to the expansion. Here in this stage also the risk amount, the risk bulk of, the risk volume is high. Then third stage is stabilization or stagnation stage. In this stage, the company considerably stabilizes its position in the market. To avoid the stabilization or stagnation, the company makes to search for new business ideas. That is, new business ideas means merger, acquisition, takeover, and other strategic alliances. These types of new business ideas the company have to select depends upon the capital structure, and at the same time the capital structure of this company is totally depends upon the idea chosen by the company, that is acquisition, merger or takeover, or then any other strategic alliances. The capital structure is, or the pattern of capital structure is chosen by the company is depends upon the business idea, that is new business idea. These are the different stages of capital structure. Then the next heading is pattern of capital structure. The composition of capital structure or the mixing of capital structure is generally classified into 4 headings. First one, capital structure with the equity shares. Yes, in this pattern, the company raise their total amount of finance through only issue of equity shares. Then second pattern is capital structure with both equity and preference shares. In this stage, the company issue both equity and preference shares for the purpose of meeting their required finance. Then third pattern of capital structure is the company issue both equity and debenture holders, that is debt capital and equity capital. Then fourth pattern, that is the last pattern of capital structure or capital mix, is the company issue equity shares, preference shares and debentures also. Yes, generally these 4 patterns of capital structure is available, but the company or a firm have to chosen a particular pattern of capital structure is depends upon the number of factors, that is such as nature of business, regularity of earnings, conditions of money market, then attitude of investors. These are the factors that company select a particular capital structure. The basic difference between debt and equity is debt is a liability, that is the debt capital, that is the company raised their required amount through issue of debentures. That is a liability on which the company has to pay interest to the debenture holders if the company having irrespective of profit, while if the company having the equity capital or equity share capital, the equity is consist of shareholders or fund or owners fund on which payment of dividend is depends upon the company's profit. That is, if the company earned high rate of or high amount of profit, the equity shareholders enjoy high rate of dividend, or if the company earned less amount of profit, the equity shareholders enjoy low amount of dividend, or sometimes the company does not declare dividend to the shareholders at that time. A high proportion of debt content in the capital structure increases if the capital structure of a company it includes or the debt capital plays a dominant role in the mixing of capital structure. It will increase the risk and also may lead to financial insolvency of the company in adverse time. That is, if debt capital is the content of debt capital is high in capital structure, it will increasing the high risk and also it will shows the financial insolvency of a business. So the raising of funds through debt is cheaper, that is the company have a chance to raise their debt capital at a lower cost of interest compared with the cost of equity and debt capital, then only the company face the competition successfully. And at the same time, if the company raise the debt capital, the payment of interest on debt capital, it is also treated as an expense, and also the company enjoy tax benefit also. Then that's why the company raise the debt capital. If the dividend is considered to be an appropriation, that is the payment of dividend is considered to be an appropriation of profit, hence payment of dividend does not result in any tax benefit to the company. The tax benefit, so this that's why the company giving or pay high attention at the time of making the mixture of capital structure. Then the next heading is uh, stages of or classification of capital structure. The capital structure is classified into two headings: pyramid shaped capital structure and inverted pyramid shaped capital structure. The first one, pyramid shaped capital structure. This type of capital structure has a long proportion of equity and retained earnings. That is, this capital structure have been plugging back into the firm's over a considerably longer period of time. That is, the cost of equity and retained earnings of a firm is usually high because they usually high, and at the same time the rate of interest, that is the cost of debt and retained earnings is usually lower than the cost of debt capital. This pyramid shaped capital structure, it indicates that the firm is risk averse, conservative and financially sound. Then second classification is inverted pyramid shaped capital structure. This type of capital structure is just opposite of first one. That is, the cost of debt is lower than the cost of equity and retained earnings. It indicates that the retained earnings of the firm are shrinking due to accumulated losses. If the company suffered or incurred losses, automatically the retained earnings is shrinking. Such type of capital structure is highly risky and vulnerable to collapse. So these are the classification of capital structure. Up to this, we have to discuss meaning, definition of capital structure, importance of capital structure, stages of capital structure, patterns of capital structure, and last one, classification of capital structure. Thank you.